ETFs. What are ETFs? How do they work? Let's see in this video. This is going to be a very long video actually. It's going to be about an hour video, and I will tell you everything that I know about ETFs, and also I will show you how to choose ETFs. So let's start this video because it's kind of exciting. It's kind of exciting. I'm going to tell you everything that there is to know about ETFs so that you can actually start using ETFs right from the end of this video. But first, if you haven't seen the video about investing, so how to invest, you should look at that video first. It's kind of a little bit more important because if you don't know how to invest, then you will not fully understand some concepts of ETFs, because ETFs are an instrument that we use to invest. So maybe look at that video first and then come back to this one. Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. And if you love the subject, please consider subscribing. What are we going to talk about in this video? What are the ETFs? Of course, before using ETFs, we need to know what are ETFs, otherwise how can we use an instrument that we don't know? Also, we will make a comparison between ETFs and actively managed funds. I will not only do a simple comparison, I don't like actively managed funds, but we will see exactly why actively managed funds are inferior and less efficient than ETFs. Then we will see how to use ETFs, in which circumstances to use ETFs, and how actually practically use them. And then maybe one of the most important things is how to choose ETFs, which is actually important. You know, there are many ETFs out there. There are so many ETFs, but how do you choose the best ones? Well, there is a technique, there is a procedure that I follow personally to choose the best ETFs. So let's start by the definition of an ETF. An ETF is an exchange traded fund. It's an exchange traded fund because it's exchanged and traded on an exchange. So it's very similar to stocks. You go on the exchange through a broker mainly, and then you buy the ETF. There is no need to go to the bank. There is no need to make contracts or sign anything or pay any commissions directly to the ETF. Maybe you have commissions from the broker, but that's okay, and that's also very plus for the ETFs because thanks to this, they are very easy to buy, therefore they're also very liquid. If you want to sell an ETF, you do it immediately. What is the difference between ETFs and actively managed funds? Actively managed funds are actively managed because they try to give you a return which is higher than their benchmark. So let me talk about a little bit about the benchmark first, because benchmarks normally are indices or a composition of indices. They can also be, but let's say that they are an index. So a benchmark could be the S&P 500, for example. An actively managed fund tries to beat the S&P 500. How? Using more or less the same companies that are in the S&P 500 or the type of companies. So big capitalization stocks, for example. So if an actively managed fund focuses on the US market, big cap stocks, then probably their benchmark is going to be the S&P 500. And they should be able to beat the S&P 500, and that is why you pay actively managed funds. You pay them a lot. You pay them around 1, 2 or 3% a year. So you pay them a lot. And you pay them a lot because you want them to beat the index of reference or the benchmark. Problem is, actively managed funds do not beat the index of reference. They do not beat the benchmark. So there is no need to pay for someone that you already know it's not going to beat the index of reference. And this is statistically, I'm not inventing it. If you look at the statistics say that more than 90% of actively managed funds in 10 years do not beat the index of reference. They do not beat the benchmark. They underperform the benchmark. They make worse returns than the benchmark, which means you pay for someone that is going to give you a return which is less than what you paid him to beat. And that doesn't make sense. ETFs, on the other hand, do not try to beat the index of reference. They do not try to beat the benchmark. They just try to replicate it. Therefore, and they do replicate it, so they have the same return of the benchmark, except for the little cost every year, which of course sums up. Therefore, if you look at 20 years, you will see that the ETF is a little bit worse than the index of reference, than the benchmark, but that's simply due to the costs. Same thing applies to the actively managed funds. The main reason why they cannot be the index of reference is because they have a lot of costs. And those costs drag the returns down to the point that they do not have a better return than the benchmark. And also, it's very hard to, even if you don't calculate the costs, it's very hard to beat an index such as the S&P 500. Therefore, even then, even if they didn't have any costs, the chances of them actually beating the benchmark is still very low. But what is practically an ETF? An ETF is just a basket of stocks and bonds. These are exchange traded funds, therefore they are only stocks and bonds. What they do is actually replicated passively, not actively, a benchmark, an index of reference. Indices can be S&P 500, for example, Russell 2000, Nasdaq, Stock 600, MSCI World, and so on and so on. They just take that index and they replicate it exactly the same. Therefore, they give you a chance to invest in a certain index. And we will talk about indices in a bit, so just wait a little bit. There are some ETFs that we can choose which have strategies. We will talk about them in a little bit. Then we have accumulation or distribution ETFs. What we mean about accumulation distribution is about the dividend. We are talking about the dividends. So some ETFs can accumulate the dividends, so reinvest the dividends in the ETF itself, or they can distribute the dividends to the investors in the ETF. So if you buy the ETF, which has a distribution policy, then you will receive the dividend that is generated by the companies which are inside the index. And then we have the replication of the ETF, which can be physical replication or synthetic replication. We will talk about this also. Who creates ETFs? Well, of course, ETFs are created by companies that choose to do it. These can be, for example, BlackRock, Vanguard Group, UBS, and so on and so on. These companies choose to have a physical replication or a synthetic replication, and they construct the ETFs they can be American ETFs or European ETFs. There is a difference, especially for the Europeans, because Europeans cannot invest in all American ETFs because they are a little bit less strict, and the European policies say that you cannot invest in American ETFs unless they have proper information. And then we have an annual cost, which is called the total expense ratio, the TER, of the ETF. Every ETF has a cost, and every year there is this cost that it's implicit into the price of the ETF. So we said that ETFs replicate indices. So instead of talking directly about ETFs, let's just talk about indices. What are indices? Indices are a group of stocks, but they can also be a group of bonds, group of currencies, or group of precious materials or commodities, let's say. In this case, because we are talking about ETFs, we only focus on stocks and bonds. So indices on stocks and bonds. The indices have a particular characteristic that they characterize a subgroup of a certain economy. So, for example, let's make an example. If we choose the S&P 500, we can see that the S&P 500 characterizes the US. We know that the S&P 500 is a good index for the US economy. Therefore, it characterizes the US economy, but it does that with a small group of stocks that are in the US economy, because it's only 500 companies, not all the companies of the US market. So with a small group, with a subgroup, it characterizes an economy. And it can also characterize a subgroup of a certain economy. For example, only the technological sector of the US market. Why it's important to understand this concept? If indices characterize a certain economy or a subgroup of an economy, and we know that the economy has to grow, guess what? Indices also have to grow. So, because the economy grows, indices grow as well. Therefore, if we invest in indices, we are indirectly investing into the economy. Therefore, if the economy has to grow, because that's how it works, if the economy doesn't grow, we all go bye-bye. So if the economy has to grow, the index has to grow. Therefore, we make money. So that is why indices are very powerful instruments to invest, but they also need to be well diversified. The less diversification there is in an index, the more probable it is that the index is not going to be profitable. If we invest in the MSCI World, which is the most diversified index out there that I know about, because it invests in the whole world economy, then yeah, we have a good chance that that index is not going to be negative. It's not going to go down in, I don't know, 10, 20 years. That's simply because we cannot imagine the world economy going down for 10 or 20 years. It's a lot. And having an economy that goes down like this, that decelerates, that goes down actually for 10, 20 years, means that our money is probably not even important at that point. Even more, the indices are very hard to go to zero, to fail. Indices, for an index to fail, we need a group that the index characterizes to fail. If we want the MSCI World to fail, to go to zero, to make us lose all the money, we need the world economy to go bye-bye. And if the world economy goes bye-bye, well, probably there is not even the need to worry about money anymore. Okay, now let's talk about the replication. We said that there is a physical replication, a synthetic replication, but let's talk about them a little bit. So, what is the physical replication? Physical replication is where the company that makes the ETF decides to actually buy all the stocks that are inside the index. So they look at the index, they see, okay, I need to buy this, and I actually go on the market and buy those stocks. Then there is like a distinction between two different physical replication. There is a total replication, the total physical replication, and then we have the optimized physical replication. Optimized physical replication simply means that the company is going to choose the most important stocks inside the index which can characterize that index, which can give you the same returns. So there is no need to buy all the 500 companies of the S&P 500, for example. Company is just going to buy some of them, the majority probably of them, which still can give you the same returns of the index. And then you have the total replication, which simply means total. So if the S&P 500 tells you to buy those 500 companies, it's a little bit more than 500 actually, but if the S&P 500 tells you to buy those companies, you actually buy those companies and you don't make any changes. The difference between the two is not actually very important, simply because the goal of the ETF is always the same, to replicate the index of reference. And then it's our job to actually verify that the ETF can replicate the index of reference. But we will see that when we will talk about how to choose ETFs. Then we have the synthetic replication. This means that the ETF, the company that makes the ETF, is not going to buy the stocks for real. They will just buy some instruments, some bank instruments. They are called swaps. I will not talk about what swaps actually are in detail, but just know that they go to a third-party bank and that they ask them to give you the returns of the index through these swaps. People say in general that these are a little bit more riskier, and yes, they are a little bit more riskier because you are actually asking for a third-party bank to help you in the making of your ETF. Therefore, if the company that gives you the returns of the index fails, you may have some problems with that. Thing is, after 2008, it's not much of a problem anymore because there are the so-called collateralizations. Therefore, the company that makes the ETF is completely protected, and even if there should be the chance that the third party should go bankrupt, there is no need to panic. The money is still safe. So nowadays, there is not much difference between physical replication and synthetic replication. Synthetic replication is actually very, very useful because it gives you a better price when it comes to exotic markets. If I have to invest in the Chinese market or in the African market, those markets actually cost a lot of money to enter physically. So to enter properly, to buy the stocks. So it's actually better for companies that want to make an ETF to go with a synthetic replication on those markets because it's cheaper. Therefore, you can give your clients, so the investors that want to invest in the ETF, a better price. And you will see synthetic replication generally costs less than physical replication. And so yes, as I said, the risks with synthetic replications are very, very, very low. Now let's talk about dividends. We said that there are two types of ETFs when it comes to dividends: the accumulation ETFs and the distribution ETF. The accumulation ETFs are the ones that actually take the dividends and reinvest it in the ETF itself. It's like a total return index. The distribution ETFs don't take the dividends from the companies that are inside the index and then give those dividends to the people that bought the ETF. So they will give you the dividends. What is better? What is worse? It depends, of course. For me, it's better accumulation. That is simply why we have a compound interest factor in that. If we keep reinvesting the dividends, we will just have more money invested. Therefore, in the long run, we can use the compound interest to make even more money. Distribution is useful only in the scenario where you have a lot of money and you want a steady income, or a more or less a steady income, because also dividends are not steady. But you need high capitals, simply because the distributions, so the dividends, are not very high. We're talking about 2-3%. If you want a 3% on a $10,000 investment, it's not that much. What are you going to do with that 3%? So if you have big capitals, yes, it may be useful if you want a steady income, but if you don't have a big capital, then probably not. Also consider taxation. It depends on the country where you live, but for example in Switzerland we have to pay taxes on dividends, we don't have to pay taxes on capital gains. Therefore, if we can automatically reinvest our dividends inside the ETF, we will make money through the dividends, but we don't have to pay taxes on those dividends. So that's something to think about. And also, of course, it depends on the personal goals. If you have the goal to have, again, a steady income, then you should think about ETF which distribute dividends. If you don't need a steady income, such as me, you don't want dividends. So why should you bother having dividends if you can just automatically reinvest it with an accumulation ETF? I said before that there are some ETFs which have strategies. These are the so-called smart beta. At least I call them smart beta. What are the smart betas? Simply, these are ETFs that have a certain strategy. Strategies have a name. They can be, for example, momentum, volatility, and so on. There are many strategies, but the most important thing that I want to understand is that these strategies are precise strategies, mathematical strategies which give you a certain goal. If you watch the returns of these strategies, some of these strategies, especially the momentum, are very, very interesting because they give you a very much more return than the normal benchmark, than the index of reference. Problem is, these strategies have a specific risk. If you watch the video on investment, you know that with diversification, we try to take that specific risk as down as possible. We don't want specific risk when we talk about investments. And so, if we introduce a smart beta ETF inside our portfolio, we are introducing specific risk. Therefore, if we want to use smart betas, we need to use them in a very, very small amount. So a very small percentage of our portfolio has to be with smart betas, not the core portfolio. The core portfolio should still be the normal standard ETF with the normal standard index, well diversified. So yes, we can use them, but use them in a very small amount, not too much, because they carry specific risk due to the strategy. If the strategy fails, then the ETF can be worse than the index of reference. Now let's talk about hedging. Currency hedging. Currency hedging is a thing that especially Europeans think about, because many ETFs are in US dollars. So if you are Europeans, this is more for you, I guess. If you are from the US, I don't think it's much for you because, again, as I said, many ETFs are in US dollars. But Europeans, let's talk about this. Do I like hedging? No, absolutely not. Hedging doesn't actually give you a lot of advantage in the long run, simply because you have to pay this hedge. If you hedge the ETF, you need to pay it somehow. You need to buy instruments that hedge the currency, therefore you need to pay it. And in the long run, I will tell you that the costs due to hedging are similar to the costs that you would have had, so the losses that you would have if you didn't hedge the ETF. So at the end of the day, it's not much of an advantage for a long-term investment. I don't hedge my ETFs. I don't hedge my investments. So I just keep it uncovered, unhedged, and that's it. I invest mainly in the US dollars from francs. The cost is intrinsic in the prices of the hedge, so you will not see a precise cost, but it's intrinsic in the price. But there are no benefits in the long term. There are no benefits simply because of this cost. But now, let's understand how to choose ETFs, because this is kind of the most important thing, okay? I know what ETFs are. I know the characteristics of the main characteristics of ETFs. How do I now choose the ETF? Well, there is a procedure, as I said. First of all, we need to understand what index. So we will see how to understand the index. Then we will choose which ETF. And then lastly, we will do the comparison between ETFs. The index. How do we choose the index? Well, of course, it depends on our goals. As we said in the video on investments are something very, very personal. Therefore, if you want to choose the index, you need to look at your goals. So at this point, you will understand, do I want to invest in the S&P 500? Do I want to invest in the stock 600? Do I want to invest in the technological sector? And so on and so on. Also, this depends on the amount of money that you want to invest, so on the size of your portfolio. If your portfolio is about millions and millions of dollars, you will have a lot of indices because you can afford that. So you can actually make more diversification, a more efficient diversification for your goals. But if you have 10 grand, then one index is fine. It's more than enough. Also, when we choose indices, we need to understand if we want an active management or a passive management. I'm not talking about actively managed funds, that's totally different. I'm talking about how we want to manage our investments. Do we want to manage it actively or passively? What I mean is simply an active managed portfolio is a portfolio that will have a lot of sectors inside. So you look at the best sectors that there are in this market right now and you invest in those. And then when things change, you change the sectors where you want to invest in, or maybe you change the instruments, or maybe you change the economies. So maybe you want to invest in the US market because you see that it's growing now. Then you want to change and invest in the European because now it's growing. So all those things, that's an active management of the portfolio. Or if you want to invest passively, completely passively, which doesn't mean that you should not check your portfolio from time to time, but if you want to invest passively, then you just choose the indices at the beginning and you need to diversify as much as possible right at the beginning, and then probably you won't change much of your portfolio for years. Whereas in the active management, you diversify a little bit less to actually go a little bit more efficient on those sectors or on those markets that are outperforming right now the general economy. You have to make this distinction simply because you need to choose which indices you want to invest in. So if I want to an actively management of my portfolio, I need to go with I will go with sector index. And maybe I can do a sector rotation, for example. Whereas with the passive management of my portfolio, I will go with more broad and general indices such as the MSCI World, the Russell 2000, and so on and so on. Instead of choosing indices, though, we can also choose asset classes. So you don't have to choose the S&P 500 if you don't want to, because maybe you don't even know that the S&P 500 exists. But you can choose the US market. So you don't need to choose the S&P 500 or the Russell 2000. In particular, you can simply choose the US market, the European market, and so on and so on. So that's fine as well. But you need to choose something. You cannot just say, okay, I want the best ETF, because it doesn't exist. There is no best ETF. There is a good ETF for that specific index or that specific asset class. So you need to choose that. Now, let's start choosing the actual ETF. What do I choose, accumulation or distribution? We talked about it, we talked about the differences. I would go with accumulation. For example, I am 20 years old now, almost 21. I have a lot of time ahead, so I want accumulation. I don't care about the profits, I don't care about the dividends, just keep the dividends and give me more return. So I go with accumulation. Do I want the hedging or not? As I said before, I personally don't like hedging. Do you like hedging? You can hedge it and you choose it. So how do we choose it? Where do we put this information? We put them in websites. If you are European, you can use just ETF. If you are American, I saw that there is ETF.com, which is a good website for American ETFs. But let's stick to the European because unfortunately, it's the thing that I know the best. So, but the website more or less work the same. So you have kind of the same filters. So what do we do on this website? Well, on this website, we will do actually the choosing part of the whole thing. We will select 4 or 5 ETFs and then we will do a comparison. But we need to do a comparison between similar ETF. That's highly important. You cannot compare oranges with apples. You need to compare oranges with something which is very, very similar to oranges, okay? Such as maybe lemons, okay? So, no, you don't need to compare exactly, you don't need to compare 2 exact ETF which follow the same index necessarily, but you should at least compare 2 ETFs which follow the same asset class, which replicate the same asset class. But, of course, it's better if you compare 2 ETFs which replicate the same index. How do you choose those 4 or 5 ETFs? You will see there is a bunch of ETFs. You don't need to choose all of them. You just choose the best 4 or 5 that you can see from the list. And how do you choose those best? You watch at the cost and you watch at the size. The bigger the size, generally the better the ETF. The lower the cost, generally the better the ETF. So you just choose 4 or 5 with these two quick things, these 2 quick characteristics. Also, the history of the ETF. The ETF should have at least as a bare minimum, a 1-year history. If the ETF doesn't have a 1-year history, it's almost impossible to compare it with anything else. There is no way you can compare just 6 months or 3 months of ETF. There is actually no way that you can see if that ETF is good or bad. But 3 years are not bad. 3 years are actually much better even than 1 year, because you can see different parts of the market, you can see how the ETF behaved, you can see if the ETF can actually sustain critical points on the market. If there is a recession in the middle, it's even better because, well, ETF can fail as well. Now, if an ETF fails, there is no worry for your money, it's all covered. But it's not nice that an ETF fails and that you have to reinvest your money in another ETF. So if the ETF doesn't fail, it's much better. Therefore, you need to have a little bit of history to see if the ETF can handle different characteristics of the market, different periods of the market. So different scenarios of the market. That's the word that I was trying to find. So 1 year as a bare minimum, 3 years would be better. More than 3 years, it's much better. Now, how we do the comparison? Now, I said that you should not do a comparison between apples and oranges, but you see an apple and an orange here, simply because this is the only image I could find on the web. But no, you don't compare 2 different things, you compare 2 similar ETFs. Now, there is a list here, and this list is actually in order. So the first thing that you see is the most important thing, at least for me. The last thing is the least important, at least for me. Now, the history. The more history an ETF has, the better. And you have to look at the history to see if the ETF can handle different market scenarios. And also, you use the history to see how the ETF can replicate the index. Not all ETFs can replicate the index perfectly. Therefore, you need to see which ones can replicate it with the best returns. So, if the ETF goes away a lot from the benchmark, it's not a good ETF. If the ETF goes close to the benchmark, it's much better, of course. And you compare that. Then you need to compare the efficiency of the ETF. This is what I just talked about. The efficiency is how they can replicate, how good they can replicate the index of reference. And you do that thanks to the history. Then you compare the volatility. ETFs have volatility, and volatility is a measure of risk. The less volatility that you have in an ETF, the better. Of course, ETFs on the same index will have a very similar volatility, but also in that case can be a little bit different. So the less volatility that you have means the better it is. This is especially true, this type of comparison is more true for those ETFs which have an optimized physical replication, because they choose which companies replicate the best the index, without choosing all companies that are inside the index. Therefore, you need to see if their optimized physical replication is actually good. You do that through the efficiency, through the volatility, and through the history of the ETF. Then you compare the costs. The less cost that you have, the better it is for you. Means simply that you will have better returns because you have to pay less. Then the size of the ETF, the bigger the ETF it is, the better it is, of course. So it's easier for a small ETF to fail, it's much harder for a big ETF to fail. Also, if you have a lot of money, we're talking about millions of dollars, it's actually very important to have a big ETF, because ETFs work just as stocks. If a big investor comes in with a lot of money at once in a small ETF, you will just first of all, you will not be able to buy the ETF actually, because you will not find liquidity. Second of all, you will risk to spike the price around. Just be careful, and if you have a lot of money, this size of the ETF is actually a little bit more important than for anyone else. But if you have standard money, I don't know, 50 grand, 100 grand, that's not a lot. So you can concentrate more on the cost, on the volatility, on the efficiency, but still, the bigger the ETF, the better, because it's harder for that ETF to fail. Then choose the physical replication or the synthetic replication. As you can see, physical replication is just the third last spot in this list, simply because it's not very much important. Physical replication and synthetic replication have very, very similar risks. So if you find an ETF that it's less expensive, bigger, with lower volatility, better efficiency, and more history, and it's a synthetic and not a physical replication, then just go with a synthetic replication and don't be worried about it. And then you look at the company that gives you the ETF. This is also important because different companies have different history and different companies have different specializations, and they know more and they are better. Of course, if a small company comes in and makes an ETF, it's gonna be worse than a company that it's been here for years, such as BlackRock, for example. So this is also another factor to consider. As I said before, if you find a physical replication that is big, that has low costs, that has better volatility, better efficiency, and more history, even if the company is kind of new and kind of small, it's okay. But if it's small, normally it will have also small ETFs in terms of capitalization. Those things are connected, but anyways, the company also is kind of important. And then lastly, we have the exchange. Again, especially if you're European, if it's on the Amsterdam exchange or on the Italian exchange or on the German exchange, it doesn't change much. Brokers in Europe give you the chance to invest in many exchanges here in Europe and in America as well, in the US as well. But if you really want to invest in your home exchange and you cannot find that ETF, of course, choose something else that can be bought in your home exchange. But bear in mind, the most important ETFs, such as the iShare MSCI World, for example, it can be found in many exchanges, not just one. I think it can be found in the German, in the Amsterdam, in the Italian, I think also in the London Stock Exchange, and also in the Luxembourg Exchange. I think, not sure, you can check it on Just ETF, but there is that. So this is the list of comparison, how I personally compare the ETFs, and this is the list in terms of importance. So most important thing is the history, least important thing is the exchange, simply because I can change the exchange. I don't need to buy it on the Italian exchange. If I cannot find it, I can buy it on another exchange. So let's go with a practical example. I chose the global economy. This is my asset class. I didn't choose the MSCI World. Let's say I don't even know if the MSCI World is an index. I don't know the MSCI World. So I don't even know that it exists. This is actually true for sector index. You don't necessarily know which indices can replicate that sector. Therefore, just choose the sector. Don't need to go in deep and to choose the precise index. Just choose the asset class. So asset class is stocks, so equity, global economy, and just ETF will give me a certain list. Then I choose the filters. For example, I chose no strategy because I don't want any smart betas. I chose the accumulating. I chose the at least 1 year of history, so older than 1 year. And I chose the size also, I think. So more than $100 million, or in this case, euros. So I filter more. Again, as I said, accumulating, larger than 100 millions, older than 1 year, no strategies. People calling me from Zurich. Okay, let's not get angry. So, as I was saying, sorry for the interruption. Yes, I filter, I use main filters, as I said before, no strategy. Then I filter more, older than 1 year, accumulating, larger than 100 million, and so on and so on. Then I organize by cost, because that's kind of more important. So I want the cheapest ETFs. And then I choose some interesting ETFs. As you can see, I didn't choose the first four, simply because I want the best ones, and the best ones are not necessarily the first four. For example, you can see here the Vanguard FTSE Developed World, and you can see that it's accumulating, so that's good, but it has only a 3 million in fund size. That's not good at all. I cannot even invest with $100,000 there. It's going to be a mess investing with $100,000 there. Not that I have $100,000 to invest, but in general terms, it's much better to go with the X trackers, for example, MSCI World Index with $4 billion, or almost five. Is that five? No, it's $4 billion. Or even better, the iShares with $17 billion. So these are the 4 best ETFs that I could choose from this list. Now, what I do is comparing them and choosing the one best ETF. No need to choose more than one ETF or more than 2 ETFs. If you have a big capital, then you may need to diversify in 2 ETFs or 3, but I chose one. It's okay, especially for this type of global economy with this 17 billion in size. There is no need. Even if I had $5 million, I could enter here, no problem. So yeah, as I said, I chose some interesting ETFs, and I go with the comparison with the list that we talked about before, and then I will finally choose the one ETF that I like, and I will put it normally in my list. I have a whole Excel list with many ETFs, and those ETFs are for a specific thing. So I have one ETF for the European mid-cap stocks. I have one ETF for the Chinese stocks. I have one ETF for the US market. I have one ETF for the bond European market. And so I have a bunch of ETFs, and if I want to build a portfolio, what I do is I want that index, I want that index, I want that index, and I already have the ETFs. So I choose that ETF, that ETF, and that ETF. I don't have to go on just ETF again and choose the ETF one by one again. I just have it in my list, and that's it. So if I want to build a portfolio, what I do is cherry pick the ETFs, the best ETFs that I have. I know those ones on my list are the best ones for those asset classes. So I just go there, tuk, 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 and pick them. So that's it. And then what do? Once we choose the ETF, we invest. So we create the portfolio, we choose all the ETFs, we create the portfolio. We can actually do the creation of the portfolio on just ETF as well. And then you can also analyze the volatility, so the risk of your entire portfolio on just ETF. Then if we are good with our portfolio, what do? Is proceed with the investment. So we go on the broker, we click buy. So there is that. It's kind of easy, I would say. It's not that complicated. It's just that you need to understand how ETFs work, and especially how indices work. And you need to understand that when you want to invest, a whole part of investment, or a whole part of investing, is actually understanding your goals and needs. And through your goals and needs, you will choose which asset classes and which indices are better for you. Once you know the asset class and you know the index, the last thing that you need to do is find an instrument to actually replicate that index or asset classes or asset class. And normally that's going to be ETFs. Hopefully, I like ETFs a lot. Of course, if there should be another instrument which is more efficient than ETFs, I will go for it. Right now, ETFs are the more efficient instrument. So, as I said before, yes, you go there and you choose the ETF. And that's it, simple. It's very simple, straightforward, I would say. As I said before, the most difficult part is actually choosing the index and choosing the right asset class for your goals. But unfortunately, no one can actually do that. No one can actually tell you which indices are the best for you unless they go have a meeting with you, and that's called a financial advisor. So he or her will come to you and ask you some questions, and together you will understand which portfolio is best for you. So which asset classes and which indices are best for you. So there is that. That's all I wanted to say about ETFs. I hope this tutorial, this lecture almost that we had, which I see here is about 50 minutes, not even 1 hour. I hope this video helped you a lot understanding ETFs, understanding how to use ETFs, and how you can build a portfolio based on ETFs. Now, of course, ETFs are not the only thing that you should invest in. As we said before, there are 3 pillars in investments. There is bonds, stocks, and these 2 things can be done through ETFs, so you can invest in bonds and stocks with ETFs. But then you also have gold. And gold, yes, there are some ETFs that give you the chance to invest in gold, but mainly ETCs. ETCs, though, we will not talk about them, at least not in the nearest future, but they are similar to ETFs. But we talked about those in the previous video, which is similar to this one, with slides and all that, when we talked about investments. Just check that video and you will see how you can invest also in gold. And these are the 3 pillars. We talked about these 3 pillars in that video about investment. So to sum it up, this is all I had to say for investment. I hope the video was helpful for you, and if it was helpful and if you liked it, please leave it a like. It's gonna help a lot with YouTube. And yes, if you haven't done it already, please subscribe to the channel. Let me know down in the comments what you think about ETFs, and do you actually love ETFs as much as I do? And yeah, I will see you in the next video.